Okay, we'll now go through exercise 16-4 on page 974. In 2016, DFS Medical Supply collected rent revenue for 2017 tenant occupancy. So the tenants paid ahead of time. Okay, for income tax reporting, the rent is taxed when it's collected. So you guys, the tax return's more on a cash basis. If we collected the rent in 2016, then we have to pay income tax on the rent in 2016. But if you'll remember, for financial statement purposes under generally accepted accounting principles, we don't record that as rent revenue until 2017 when we actually earn it. Okay, so this is going to create a temporary difference. It shows up as income on the tax return in 2016 when it's collected, but it doesn't show up as income or revenue on the financial statement, specifically the income statement, until 2017 when the landlord earns it. So, let's see how we're going to handle this temporary difference. They go on to say what I just said. For financial statement reporting, the rent is recorded as deferred revenue, then recognized as income or revenue in the period tenants occupy the rental property. The deferred portion of the rent collected in 2016 amounting to $300,000 at December 31, 2016. Okay, we're going to have to pay taxes on that today, or in 2016. Even though it's not going to show up in net income until 2017. DFS had no temporary differences at the beginning of the year. Okay, and assuming an income tax rate of 40%, and 2016 income tax payable of $950,000, prepare the journal entry to record income taxes for 2016. Okay, this will be December 2016, December 31. Or, well, we know we're going to debit income tax expense for book income, which we don't know yet, times the tax rate. Then we'll have deferred tax asset or liability. We'll see which one. We'll leave a space for it, and then we're going to credit income tax payable for what's actually due to the IRS. And remember, we calculate that by multiplying taxable income times the tax rate. You guys, we don't even have to do that here. They tell you income tax payable is $950,000. So they give us this amount. Okay. What we're going to have to do, though, is figure out what our book income number is. Okay. First, we're going to have to get the taxable income, and then we can take out the temporary difference. Taxable income is going to be equal to income tax payable divided by the tax rate. See, to get income tax payable, we would have multiplied the taxable income times the tax rate. If we want taxable income and we know income tax payable, then we can take income tax payable and divide it by the tax rate. Okay, so I'm going to say our $950,000 income tax payable divided by 0.4, the tax rate. So our taxable income is actually equal to $2,375,000. Now, our pre-tax accounting income or book income is going to be equal to our taxable income Okay, but remember, included in taxable income is rent we collected in 2016 for 2017. They made us include that full $300,000 in taxable income. It won't be included, though, in income statement or book income until 2017. So that $300,000 needs to be subtracted out to get pre-tax accounting income. It needs to be subtracted out from taxable income. So that gets us pre-tax accounting income of $2,075,000. Okay, so if we want income tax expense, we'll say pre-tax accounting income $2,075,000 times our tax rate of 0.4. So we get income tax expense of $830,000. Okay, this time to balance the entry, we need more debit. So we've got a deferred tax asset with the difference $950,000 minus $830,000. That's $120,000. So here's your entry. The tricky part, I think, was determining taxable income. You know your credit to income tax payable, that's given. Okay, to get taxable income, you got to take income tax payable and divide it by the tax rate. We needed that number because we knew that the deferred rent of $300,000 was included in that number, but not included in pre-tax income. So to get pre-tax accounting income, we took our taxable income and subtracted the $300,000 rent collected for 2017 that we won't pick up on the income statement until next year. So that gets us pre-tax accounting income of $2,075,000. We multiplied that by the tax rate to get income tax expense. We needed more debit to balance the entry, so we have a deferred tax asset of $120,000. Okay, that's it for exercise 16.4. After working that one with me, I don't think you'll have any trouble with that exercise on the Connect Plus site. Good luck.